Welcome back to Talk Tickers. This is the show for the experienced investor. We try to strip away all the noise.
All the PR fluff.
Exactly, all the corporate PR fluff, and just get straight to the numbers. Today, we are turning our attention to the upper Midwest, specifically the Twin Cities.
It's a fascinating morning to be looking at Minneapolis banking.
It certainly is. And just to set the timestamp, we're recording this on the morning of January 28th, 2026. The Q4 2025 print for Bridgewater bank shares, that's ticker BWB, it dropped just a few hours ago.
And the stock's reacting.
It is. If you're looking at your terminal, it's indicated up about, 1.84%, hovering right around $18.46.
So not a massive gap up. No one's retiring on today's move.
No, but it's green. And considering the headwinds for the sector we've seen, that feels like a constructive signal. It feels like validation.
It does. But before we get into the weeds of basis points and efficiency ratios, and we will get into the weeds, give us the high level why it matters.
Right. Why should a generalist investor, maybe someone focused on tech or healthcare, care about a regional bank in Minnesota right now?
Because the entire regional banking game right now is about one thing: the race to profitability. Everyone took a massive hit when rates spiked. Balance sheets got underwater, margins just got crushed.
A tough couple of years.
For sure. Now, as we enter 2026, the question is, who climbs out of that hole the fastest? Most banks are telling Wall Street, be patient, give us 2 years. Bridgewater came out this morning and essentially said, we can accelerate that, watch this.
So management moved the goalposts, but for once they actually moved them closer.
Precisely. They updated their net interest margin targets in a big way, pulling that whole timeline forward. That is the real hook today.
Okay, so that's the stake. Let's look at the scoreboard. I want to run through the ticker tape, just the headline numbers. Stick with me here.
Let's do it.
First up, GAAP EPS came in at 43 cents. The consensus was 42 cents.
A penny beat. Modest, but a beat is a beat.
Revenue landed at $38.84 million. That beat consensus by nearly $1 million. And notably, that is up 32% year over year.
And that 32%, that's significant. That is not cost-cutting your way to a profit. That's genuine top-line expansion in a really tough environment.
Then we have my favorite metric for this kind of analysis. Tangible book value per share came in at $15.55. That's up 15.3% year over year.
Can we just pause on that for a second? I feel like tangible book value gets glossed over way too often.
Please unpack it. Why should the listener care so much about that number?
Well, tangible book value, or TBV, is the true value of the bank if you liquidated it today. Assets minus liabilities, but you strip out all the goodwill and intangibles.
Hard assets.
Right. And in banking, TBV growth is basically the proxy for value creation. If a bank is growing TBV by 15% a year, they are compounding shareholder wealth at an absolutely elite level. Most banks are happy with, 6 or 8%.
So if the stock price tracks TBV over time, which it usually does, that 15% is kind of your baseline return.
Exactly. And then you add the final piece of the puzzle from the headlines, the efficiency ratio. It improved to 51.6%.
Which is good. You want that number low.
You want it very low. A lot of their peers are hovering up in the 60s. Being at 51.6% means for every dollar Bridgewater brings in, they only spend about 51 cents to run the place. That's a lean ship.
Okay, so the headlines look good, but I have to play the skeptic here. Sometimes you see a beat, but when you dig in, it's all accounting gymnastics.
Releasing loan loss reserves or something?
Exactly, or a one-time tax credit. Was this a clean quarter?
That is the right question to ask. And looking at the breakdown, this looks like high-quality core execution. It wasn't a trick.
Okay.
You had strong loan growth at 8.9% annualized. But what was more impressive to me was that it was matched almost perfectly by core deposit growth at 8.8% annualized.
Why is that matching so important?
Because usually right now, you see banks struggling on one side of the balance sheet. They're either growing loans but bleeding deposits, which means they have to borrow expensive wholesale money to fund it, or they're hoarding deposits but are too scared to lend.
BWB is balancing the scale.
Perfectly. They are funding their own growth. It's organic. And you could hear that confidence in management's tone on the call. The CEO, Jerry Back, described finishing the year strong. It just didn't sound like corporate speak.
It sounded like validation.
Yeah.
Okay, let's get into the deep dive. We've broken this down into 3 segments. Segment 1, the margin acceleration. We're calling this one the pull forward.
Right. This is the technical core of the thesis. Let's look at the net interest margin, or NIM. It landed at 2.75% for the quarter.
Okay, and that's up 12 basis points from the prior quarter.
It is.
Now, 12 basis points. That sounds like a rounding error to a crypto trader or a tech investor. Why is everyone so excited about 0.12%?
Because banks are just massive, highly leveraged entities, a 12 basis point expansion across a multi-billion-dollar balance sheet, that drops straight to the bottom line. It is pure profit. But the real news isn't the 275 they just hit. It's where they say they're going.
The guidance update.
Yes. Previously, management had guided investors to expect a return to a 3% NIM by early 2027. That was the old roadmap.
And on this call?
On this call, they officially updated that. They now expect to hit that 3% target by the end of 2026. They've shaved about 2 full quarters off the recovery time.
How? I mean, is this just optimism, or is there hard math behind it?
Oh, there is very specific math. It's a two-sided equation. First, look at the liability side, what they pay depositors. Deposit costs fell 22 basis points this quarter to 2.97%.
That's a pretty sharp drop.
It is. And it happened largely because of those Fed cuts we saw late last year. Bridgewater has structured their balance sheet so that they have about $1.4 billion in immediately adjustable deposits.
As soon as the Fed cuts?
As soon as the Fed cuts rates, the interest BWB pays on that $1.4 billion just drops instantly. They don't have to wait for CDs to mature or anything like that.
Okay, so their funding cost, their raw material, it's just got cheaper. What about the assets, the loans they're making?
This is the repricing engine. They have $637 million of fixed-rate loans maturing in the next 12 months. These are older loans, currently yielding about 5.55%.
Which in this environment is fine, but not great.
Right. But new loans are coming onto the books in the low to mid sixes. Let's just call it 6.5%. So simply by the passage of time, as those old loans mature and are replaced, they're picking up a spread of nearly 100 basis points.
It's like a conveyor belt. The low-yield stuff falls off the end and the high-yield stuff gets put on the front.
That's exactly it. Plus, they have another $106 million in adjustable loans repricing immediately. It's just a mechanical process that drives the margin higher.
But I have to push back here. You mentioned the deposit costs dropped because of the Fed cuts. Is this whole 3% target dependent on the Fed slashing rates again in 2026?
That is the single most important question.
Because if we've learned anything, it's not to bet the house on the Fed's dot plot.
Exactly. And if this thesis relied on Jerome Powell cutting rates 3 times this year, I wouldn't touch it. But management was explicit on the call. This target, the 3% NI by year-end 2026, it does not assume additional rate cuts.
Really? 0 cuts modeled in?
0. They modeled a flat rate environment. If the Fed does cut, that's just gravy. It pulls the timeline forward even more. But the plan works even if rates stay flat.
That is a crucial distinction. It transforms this from a macro bet into an execution play.
100%. They control their own destiny on this.
Okay, let's pivot to segment 2. We're calling this one the secret sauce. Because every regional bank claims they're relationship-focused. It's the biggest cliche in the industry.
It really is.
But BWB seems to have a very specific niche that's doing the heavy lifting.
Affordable housing.
Let's talk about this. When people hear affordable housing, they might think of, low-margin government projects. But for BWB, this is a massive business line.
It is a serious revenue driver. In Q4 alone, their affordable housing loan balances were up $41 million. That is 27% annualized growth. For the full year, that vertical was up 29%.
That's explosive growth for a bank. Why this specific niche?
It's strategic diversification. Think about it. If you're just a general commercial lender in Minneapolis, you are tied to the local Twin Cities economy, right? If the local economy slows, you slow.
Makes sense.
But affordable housing is a national, or at least a semi-national play. The demand for tax credit financed housing isn't correlated to the luxury condo market in downtown Minneapolis. It is robust everywhere.
So it allows them to export their balance sheet, in a way, outside their immediate geography.
That's a great way to put it. They're using local expertise, understanding these complex tax credits and capital stacks, and applying it broadly. And it connects to fee income.
Right, the swap fees, the non-interest income. They generated $651,000 in swap fees in Q4.
Which is a nice chunk of change.
For the listener who isn't a CFO, break down the mechanics. Why does an affordable housing deal generate a swap fee?
Think of it like insurance for the developer. These guys are borrowing huge sums of money for long periods. They are terrified that interest rates will rise and kill their project's economics.
So the bank sells them a fix.
Exactly. The bank sells them an interest rate swap a contract that fixes their rate, and the bank charges a nice fee for arranging this. Now, management did admit these fees are lumpy. You can't predict them like clockwork.
And they might slow down a bit.
They might slow a bit in 2026 just due to the shape of the yield curve. But as long as that affordable housing vertical is growing at 27%, the opportunity for that fee income is structurally higher than for their peers.
Okay, segment 3, market disruption. We love a good M&A story, and the Twin Cities seems to be ground zero for bank mergers right now.
It is chaotic. You have Old National acquiring Bremer. You have pending deals for Midwest One and American National. That's a lot of moving pieces in one metro area.
And usually Wall Street cheers for M&A synergy and scale.
Yeah.
But BWB is just watching from the sidelines. Why is that an opportunity?
We call it displacement. When two big banks merge, two things happen. First, talented bankers get nervous. They worry about their jobs, their comp, the bureaucracy. Second, clients get frustrated. Their favorite banker leaves, systems change, credit decisions take forever.
And BWB is just sitting there with a catcher's mitt.
Exactly. The CEO, Jerry Back, was very clear about this. They view themselves as the bank of choice for displaced talent and frustrated clients. They are now the second largest locally led bank in the Twin Cities. That positioning is really powerful when everyone else is distracted.
And speaking of integration, BWB just finished their own cleanup right from the first Minnetonka City Bank acquisition.
Yes, that is now fully in the rearview mirror. In fact, they just closed a branch they acquired from them in December.
A branch closure. In banking efficiency terms, that's beautiful.
It was redundant, too close to another branch. Closing it reduces overhead without really sacrificing coverage. It signals discipline. The CFO said expense growth is returning to alignment with asset growth. So, high single digits.
The indigestion period of their own deal is over right as their competitors are starting theirs.
Timing is everything.
Okay, we have to do it. We have to address the investor context. The elephant in the room, credit quality. Is the portfolio going to blow up?
It's the only question that matters for valuations right now. And, well, the reality is it wasn't a perfect quarter on that front.
Give us the bad news first.
Non-performing assets, or NPAs, they ticked up slightly. They're now at 0.41% of assets.
Okay, 0.41%. Contextualize that. Is that panic mode?
No, not at all. Historically, anything under 1% is considered very healthy. During 2008, you were seeing 3, 4, 5%. So this is benign, but it's an increase.
What drove it?
Specifically, they had one multifamily loan go non-accrual.
Meaning the borrower stopped paying.
Right. It sounds like a deal-specific issue. The client's purchase agreement fell through. But, and this is key management noted, it is already under a new contract. So it doesn't sound like the building is empty or the market collapsed. It was a transaction failure.
Okay. And what about charge-offs? Did they actually lose money?
Net charge-offs were $1.2 million in the quarter. That was related to a single C&I loan, commercial and industrial.
$1.2 million isn't nothing.
It's not, but you have to zoom out. For the full year of 2025, their net charge-offs were only 0.04% of average loans.
4 basis points.
It's microscopic. Most banks would kill for that credit performance.
And the boogeyman everyone's scared of, office CRE.
Exposure remains low, under 5%. And importantly, it's mostly suburban, not central business district. They aren't holding the paper on empty skyscrapers downtown.
So the verdict?
These look like isolated incidents. It does not look like systemic cracks in the foundation. And that validation really explains why the stock trades at such a premium. I mean, BWB is up over 34% in the last year. The KRE Bank ETF is up, what, 10%?
The market's paying up for that quality.
It is.
Okay, that's the deep dive. Now we move to the segment everyone waits for, the This Is Not Financial Advice segment.
The lawyer's favorite part of the show.
Exactly.
Yeah.
Standard disclaimer.
Yeah.
We are just two voices on a podcast. We are not your financial advisors. Do your own diligence. But purely for entertainment and intellectual stimulation. If I'm a hedge fund analyst pitching to the investment committee right now, what is the trade?
I've been thinking about this one. I think I'd call it the Twin Cities displacement long short.
Ooh, a pair trade. I like it. Break it down.
Okay, the setup is this. You go long Bridgewater, BWB, and you short a generic, acquisitive regional bank. Maybe a specific peer that's bogged down in a messy integration.
What's the thesis driving that spread?
On the long BWB side, you're buying NIM velocity. You have a bank that's repricing its assets faster than its peers, with over $700 million in loans repricing this year. That is a tangible catalyst.
You can model it?
You can model it. You're also buying the affordable housing alpha. It's a high-growth vertical most generalist banks just don't have. It's a moat.
Okay, so you own the growth and the margin expansion. Why the short?
Because integration is hell. You're betting the M&A chaos in Minneapolis, that old National Burmer situation, is going to cause friction. You're betting on a deposit flight.
How big a flight?
Let's get outrageous.
Yeah.
I'm betting that a 10% movement of frustrated commercial deposits leaves those big acquirers and lands directly in BWB's lap over the next 6 months.
You're betting on the friction of the big guys fueling the growth of the agile guy.
Exactly. And the kicker is that tangible book value growth. BWB is compounding book value at 15%. So you're capturing that compounding machine while hedging out the broad sector risk with the short leg.
I have to say, the plausibility rating on that is high. It's a classic execution versus integration risk pair trade. You aren't betting on the economy, you're betting on management teams.
And in regional banking, management is the only competitive advantage that really lasts.
Love it. But again, not financial advice.
Purely hypothetical.
Just a thought experiment. All right, let's wrap this up. Recap the flags for us. What are we watching?
Green flags. The 3% NEM target being pulled forward to 2026 is the big one. We need to see them hit those quarterly markers. Affordable housing scaling at 27%, that's your growth engine. And expenses need to stay under control now that the merger's done.
And the yellow flags.
You have to watch the credit, specifically that multifamily niche. If we see another one or two of those isolated hiccups next quarter, the narrative changes from isolated to a trend.
We need those MPAs to stabilize.
Or drop back down, yeah.
Fair enough. Final thought.
I think BWB is proving that in a flat or even a confusing yield curve environment, specialization beats scale. You don't need to be the biggest bank. You need to be the specialized bank that can move fast. They are agile, and right now, agility is winning.
Agility is winning. I like that. We'll be watching to see if they hit that 3% mark by year end. Keep your eyes on the ticker. We'll see you for the next print.
See that?